Hello and welcome to another episode of the Express Economist. Today we have with us Dr. K Joshi, the Chief Economist with CRISIL, and we'll talk to him about the recently released GDP estimates. As many of you know, earlier this week, the government released the second advanced estimates for gross domestic product and gross value added. And we'll look at both the things. One, we'll look at the Q3 GVA results, which is looking at the phase between October and December. How did the economy do? What did the different sectors do? And we'll look at the GDP numbers for the whole year. But these are the second advanced estimates. The financial year hasn't ended as yet. And so these are just the second advanced estimates. The first advanced estimates had come in January. We've done several stories on this. So on the website, you can find the relevant content. And I have a bouquet of 6 odd questions about the GDP, the very interesting trends that we can see. And I'll kickstart the discussion, first of all, by welcoming Mr. Joshi. Thanks for coming to the show.
Thank you for having me.
And I'll kickstart quickly with the first question on the Q3 performance. One of the key things about the third quarter, which was October to December, was that this was a phase when we typically see festive bump. There are festivals and people tend to spend more and there is more economic activity. And looking back, even at the COVID numbers are fairly muted during these 3 months. So there was expectation that the third quarter, economic growth would be a more robust number or a much higher number. Now, when we look at it sectorally, different sectors of the economy find all the sectors grew at a slower pace than what they grew in the second quarter. That is the 3 months before that. And in particular, manufacturing and construction, these are two sectors which create a lot of jobs. Manufacturing barely grew, construction actually contracted year on year. Now, just wanted to first of all understand how do you read the third quarter performance of the Indian economy?
Well, I think the year-on-year growth number for Q3, which you're talking about, I think at 5.4 was definitely below what the street was expecting. And you also rightly point out that the growth in various components of GDP has slowed down. I think it's across the board. I'm not so much worried about the slowing growth with respect to the previous quarter. That would have happened in any case because of the base effect. I mean, if you look at the Q1 GDP for 21-22, it's close to a little over 20%, I guess. And Q2 was at, Q3 came in at 5.4. So it was gradually weakening in any case because of the base effect. And what base effect means here is that the 20.3% growth in the first quarter was over close to 23% decline in GDP growth in the first quarter of the previous year. So I think that kind of statistically lifts the growth up. And that effect wanes as you progress towards normalization. So I think that's not the worry. The worry to me is that it is slower than what was expected. I think that is the major worry. For instance, we were expecting GDP to grow at 6% in the third quarter, but it came in at 5.4%. And I think you rightly point out that the slowdown is due to manufacturing and due to construction. I think these are the two labor-intensive sectors in the economy, construction particularly, which is the most labor-intensive after agriculture. So construction slowing down is, of course, a worry. It's not so easy to explain what happened, but I think if I look at some proximate reasons, I think I can, when I look at construction, government did slow down the capex, I think in the third quarter. So that spills over to the construction activity. The monsoon was also a little more into October. I mean, there were delayed rains, etc. And that actually does disrupt construction activity. So these seem to be some proximate reason. And the manufacturing, I think, was suffering from more from supply side effects, and also I think because of the demand didn't pick up that much. I mean, for manufacturing products, I think so. This mostly reflects the supply side bottlenecks which slowed IIP industrial production down. It was already visible in the monthly index of industrial production data that we are heading for a very weak manufacturing activity. So that also didn't come as so much of a surprise. I think big surprise was, of course, the construction in comparison. Now, if you look at other components, I think the one component which picks up typically when the COVID is down is the contact-based services, and I think which is trade, hotels, etc. I think if you look at that has shown that's slower than the previous quarter, but I think it's reasonably healthy. I think that is the bounce back which was expected. So that was due to normalization of activity which happens when the COVID is down. So I think the overall contact-based services for the full year may not be doing that well, but at least in that quarter they did pick up.
Right. So this is very interesting to understand, because when we look at the Q3 GVA numbers, the sectoral performance, as you said, manufacturing, or on the GDP side, the consumption, the demand coming back wasn't as much. But when we look at the overall GDP numbers for the whole year, and we compare it between the first advanced estimates, which came out on January 7th, and the second advanced estimates, which came out earlier this week, we find a remarkable story unfolding. The overall GDP numbers are the same, and I've done a story about this, pointing this out. The overall GDP numbers are the same, but if you look at the engines of growth, you find that the picture has turned very rosy, because in the picture, one of the main concerns earlier was private consumption was very low. It was much below the pre-COVID level. And now the data shows that private consumption is actually has rebounded quite remarkably. Within 2 months, first of all, I want to understand, how do the estimates change so dramatically?
Well, I think the full year estimates do reflect an incomplete recovery. I think despite private consumption picking up, and now I think all the components of demand, I think are above their pre-pandemic levels. I think the first advanced estimates are based on very limited information, I think, first of all. And so any change in them is to be expected. I think as we go deeper into the year, we'll see that the numbers will change. And I think one of the other reasons why the growth rates in the second advanced estimates changed was also because the previous year got revised. Somewhere between the release of first advanced estimates and second advanced estimates, provisional revised estimates for 2021 were released, and I think that also kind of distorted changed the figures a bit. So there are typically 2-3 reasons why I think the first and the second advanced estimates differ. First of all, I think you need to understand why first advanced estimates were started. I mean, this was not a usual practice in CSO. This started in 2017, when I think government advanced the budget to 1st of February. So they needed the information for taking for budgetary arithmetic, etc. So this was a much weaker estimate, I think, based on very little data. All the data available till December was used for this, and which essentially means that given there are lags in data, so you had only data till October. So obviously, I think so the estimate is a kacha estimate, so to say. So it had to be revised. I mean, there's no doubt about it. And I think we've seen some revisions are not. I won't say that they're earth-shattering, though private consumption has moved up, but by how much? I mean, it is very little movement. I mean, and that much is the margin of error usually in the data, I think. So it's changed the story a bit, but it hasn't. I think the overall macro picture, I think, hasn't changed too much after the release of the second advanced estimate.
So if you could, that's a very important question, and we'll maybe link the story that I did where we explain that there are several revisions that happen to every GDP estimate for any particular year. You have the first revised estimates, second, third, before you come to actuals, and this takes 2-3 years, 4 years. And 2019-20, the year before COVID, was a particular year because it's a recent one where from budget estimates of 8.5% growth, we ultimately ended with, as of now, 3.7% growth. So, I mean, the story unfolds very differently. But I want to ask you to recap the story of the Indian economy in this recovery phase. So what exactly has happened? Can you just tell readers in short what exactly is happening? What part is lagging? What part is leading? What's the story happening?
Yeah, sure. I think that's a particularly important question because you look beyond the overall headline numbers here. The story that is playing out, I think, is of incomplete recovery. I think there's no doubt about it, and it's not a balanced recovery as yet. First of all, the contact-based services, which is also labor-intensive, by the way, they are as labor-intensive as manufacturing activity, and they are based out of mostly urban areas. Two-thirds of the contact-based services are in urban areas. I think they are still about 11% lower than 2019-20 levels. So it means that there's a very severe hit to this segment, and this is one segment which gets repeatedly hit by each way, because first of all, you have to avoid contact, I think, to avoid transmission of virus. So they are the ones that get impacted first. The second is, I think, as far as the weakness in the economy is concerned, I think it's not only limited to, as I said, contact-based services being in the urban areas. It's also, I think, being felt in the rural areas. If you look at the consumption pattern of durables, etc., I think there is weakness which is very clearly visible. That I think that despite agriculture doing well, I think the Manrega spend, etc., if you see the trends, I think the demand for jobs is more than the supply of jobs. So all that is pointing towards lack of job opportunities. So I think that is another aspect. I think the consumption recovery, as I was pointing out, is extremely tepid right now. I think you look at the consumer confidence surveys of RBI, this picking up. I mean, as the economy normalizes, you will see some improvement, but it is an improvement in confidence. But compared to what it was, the level of confidence compared to the pre-pandemic period is still lower. So, and I think what is really interesting is one estimate that we compute for inflation, which is how are the bottom 20% of the population facing, what kind of inflation they are facing compared to the top 20%. And what we find in urban areas, I think the inflation faced by the poor or the bottom 20% is higher than that is faced by the rich. So if you combine all this, I think it tells you that there are various dichotomies that are playing out in the economy.
Okay, so just to circle back to the question of revisions, because you mentioned that there is considerable stress still. It's not as if everything has become hunky-dory. Do you expect significant revisions in the years ahead for this particular financial year?
Well, I think there could be revisions for several reasons. One is, I think, as more and more data becomes available, you keep revising. So you will get another set of data in May 31, which will have a somewhat higher shelf life than the estimate that we saw, because after that the revision will come only next year, and it will be a firmer estimate. But beyond that, I think typically what happens when you compute GDP, the informal sector, the small sector, I think they don't get adequately captured. I mean, they are estimated based on proxies and which are in some way related to the formal sector, and formal sector we know is doing well. So there could be it's possible, I don't know. I mean, there could be an overestimation bias in some of these numbers, which could get corrected as we go ahead. So I think even in normal years, GDP keeps changing. I mean, there is, I think, first advanced estimates, second advanced estimates, then there is provisional, then there is revised, then there is actual. So I think by the time you come to know the speed of the economy, what the actual speed was, it's already, I think, 3-4 years ahead. I mean, so at that time, that information doesn't help much.
True, and that's why these debates are so intriguing, because many different strands can be talked about, and many of those things may change quite considerably. One last question, just sticking with the quarterly estimates. The fourth quarter estimate, as you said, we'll be adding that number by May end. We'll have that data, and we'll have the provisional estimates for the full year. In the fourth quarter, we've seen in January the Omicron surge really happened during January, and perhaps the maximum impact. And now what we are seeing underway right now with the geopolitical tension and the impact it may have, maybe in a lagged manner because we have elections, and so oil prices may not be updating as fast. How do you see that impact playing out, the fourth quarter, the impact on fourth quarter?
Well, fourth quarter is in a way the most disrupted quarter of 21-22. It was the quarter where the Omicron started having its impact. It was, I think, it was visible in the mobility data, which is, I think, very closely tracked these days. I'm talking of Google mobility data. But I think the what's also true is that the impact was less than the previous quarters. So if I compare the three waves, just to put things in context, if I compare the three waves, the mobility had fallen by something like 86% during the first wave. In the second wave, it fell by close to 60%. In the third wave, at the peak of the wave, the mobility had fallen by only 15%. So successive waves are less and less impacted, and COVID and Omicron also proved to be mild, I think, compared to the other waves. So I think that means that only the contact-based services got impacted more. I think that we saw. I mean, that was visible in the data also. Now, this so 1.5 months out of the quarter, I think we saw the Omicron story play out. In the rest of the quarter, I think the story that is playing out is the geopolitical story. The risk from Omicron was very quickly replaced by a massive risk from Russia-Ukraine conflict, and which I think is led to high crude oil prices. It will also lead to some disruption of trade. Now, the point is that the full effect will not play out in this quarter. There is a lagged impact. I mean, you always have buffers. So how this plays out, I think, is very difficult to guess. So the fourth quarter estimate, I think, which is implicit in the GDP growth, because you have the annual GDP, you have 3 quarters, you can compute the fourth quarter GDP. What is implicit is likely to change, I think, as we go ahead. And I think, as I said, it's very dynamic, and there are too many moving parts in data. And it becomes very difficult to get to the right speed of the economy, I mean, at this juncture.
Okay. Now, let's move to the next, to the year ahead and the years ahead. We've looked at GDP. There are 2 questions I had, and we'll finish with that. One is that, there are 2 different ways in which people are looking at the economic recovery. One set of people are saying, listen, going into to the COVID pandemic, India's growth was decelerating sharply from, something like over 8% to less than 4% over the 3 years going into the pandemic. And so coming out of the pandemic, why would it be terribly higher? The other view is the more optimistic view, which is saying that coming out of the pandemic will be growing at 7 or 8 or 10% or whatever. Now, where does the truth lie, or where do you see this happening? How do you see this panning out?
Well, I think it's true that the economy had slowed down, but what is also true is that economy doesn't move in a straight line. I think there are growth cycles. So you were in a lower growth cycle, and growth would have picked up in any case. I mean, maybe it's got delayed because of COVID. So there is. So I think that I would not extrapolate the 4% growth as a new trend in the economy. I think our expectation is, let me start with our forecast for 22-23 is around 7.8% GDP growth in 22-23. Now, even with this, I think the level of GDP in 22-23 will be 10% lower than where it would have been if there were no COVID. So which means 10% permanent loss of GDP. Now, how do I get to where it would have been? I think what I have done is, instead of taking 4% as a trend, I have taken the decadal average, which is around 6.7% as a trend. So if it had been growing at that rate, and it's fair to assume that it would have been growing at that rate, because you are now coming out of the low cycle. I mean, so the cycle would have changed. I mean, typically it doesn't last very long in India. I mean, that's what we have seen. So I think there is one issue, is that there is a permanent loss of GDP, even if the economy recovers to 7.8%. Now, beyond that, I think if you look at, let's say, what we call the medium term or next 4 to 5 years, I think I think 7% growth is feasible because of the PLI scheme, which creates some upside to private sector capex cycle, and also government's focus on infrastructure. Obviously, I think implementation is the key, but I think this gives you some hope that this is, I think there is some driver which is going to play out. Look at GST. I think it was not very positive for the economy in the initial years, but suddenly during the pandemic years, you saw the GST collections improve. So the positive effects of moving to a unified tax scheme, it still has many issues, but I think some positive effects were visible, and that's why you're seeing. So these are some of the things that will help the economy. But I think the bottom line is that the 10% GDP loss that I'm talking about is not going to be wiped out by this 7% per annum GDP growth for next 5 years. You need at least 13% GDP growth for next 3 years to reach the pre-pandemic trend level of GDP, which is not so I think that is the story. So you've lost a large part of GDP, which you can't recover even if you grow at 7%.
Can you, because you mentioned permanent loss of GDP, and a lot of our viewers might wonder what exactly how to wrap your head around permanent loss of GDP. What does that mean? Can you?
Well, I think permanent loss of GDP is a term that is used to estimate how much back have you been pushed by the pandemic. So, I mean, so there is a level of GDP which would have been there if there were no pandemic. So, which typically is the forecast that you would have made before the pandemic struck. So, from that level, how low you are, and are you going to catch up to that level or the trend that you were visualizing before the pandemic? So I'm saying that we are 10% below that level, and the gap is unlikely to be bridged unless we start growing very fast beyond 7% per annum. I think so that becomes, in a way, you've lost it forever. I mean, so it varies from different countries. I think for some countries it is higher. For richer, advanced countries, the permanent loss is lower because they very quickly gave a huge amount of stimulus. They had the money to do that. So they're going to move closer to the trend very quickly. I mean, trend level of GDP. I'm not saying trend growth rate. Growth rate is the level. I mean, level is more important because that is on the basis of, that's the basis of computation of per capita income, etc., etc. So
yeah, I mean, I keep always going back to the haircuts that we didn't have during the lockdowns, and those are permanent losses because those haircuts eventually were lost because you just had one instead of three. Last question on what are the challenges ahead in the next 12 months. So, I mean, it's difficult to conjecture right now with so many things happening, but what are the 2-3 main things that India needs to be wary of?
Yeah. I think that's an interesting question and a little difficult to answer also because the challenges are also shifting. I mean, as the risks are shifting, the biggest challenge I would say on the basis of what we are experiencing right now is crude oil prices. I think given that we have a huge import dependence, every time crude prices go up, I think it creates stress for the GDP. It creates stress on the inflation, and it also increases India's current account deficit, I think. So it's got a impact which spills over to many macroeconomic variables which reflect the fundamentals also. Now, how much the impact will be depends on how much the crude prices rise and how long they stay there. I think one spike and then coming down is okay, but if they stay above 90 or above 100 for 12 months, I think then we are in for a serious challenge. I think it will not only raise inflation, I think make monetary policy decision making difficult, but also I think throw the fiscal math completely, I think, awry, I mean, so to say, because the strategy is to raise investments, reduce the subsidies, and that I think that strategy will have to be reversed. I mean, because your subsidy bill will go up. I think because it's impacting in various ways. I mean, fertilizer prices are also going up. I mean, they are also in a way linked to crude prices and also now to the Ukraine crisis. So I think the policy path of engineering investment-led recovery in the economy will face challenges. I mean, if the other spending tends to go up, and that's related to crude. So I think that to me is one serious problem that we have. The other, which is one notch lower, is what the US Federal Reserve is going to do. I mean, which is if they surprise, and they have been surprising so far, then I think we could see turmoil in the capital flows. We could see turmoil in the currency, but for the emerging markets as a whole. But I think good news there is that India is not a part of Fragile Five. I think it has done its homework since the last 2013 crisis. So we have enough forex reserves. Our foreign debt is also not that much. Current account deficit is low. So you have better ability to withstand that. You're not, nobody is immune to that. I mean, that kind of disturbance. And now if you take it together with what's happening in Ukraine and Russia conflict, then I think the problem magnifies, I mean, in a way. I mean, so you, and the surprises and uncertainties on how the policymakers are going to react, particularly monetary policy, that also rises. So I think you're living in a very, very uncertain environment. And I would, if I were to highlight a top risk, I would say right now it is the crude.
That's very well put. And oil is going to be a massive factor determining how the economy performs. Thanks for taking time out and giving us so generously your time and insights and being part of the show, Dr. Joshi. Thanks a lot to all of you also for watching the show. And I'll send out some of the links that we talked about, the stories that we've done. You can read those stories along with this video to understand how the GDP needs to be appreciated. Thank you.